back. Final hour session just after 3 p.m. Eastern Time on Monday, June 9th. So let me grab a couple of things, send out a message really quickly. Let's see here, 3 p.m. Eastern Time, final hour live. And we have gold, silver, Bitcoin, uranium. All right, 1 second here. Okay, so overall, I mean, markets are up, but pretty boring day. Took a couple of trades with the pinch point scanner today. We priced out. We ended up going for almost an hour and 20 minutes. Ended up taking 2 trades live. Probably tried to get into like 5 or 6 trades. Just didn't quite get the fills that I wanted. Had a set number in mind. I'm not going to overpay for some of these options, but plenty to shake a stick at. We've got 26 stocks that are all poised and ready over some movement. I didn't love all the option prices, like $5 wide strikes. Some with earnings, some without, and just a normal course of action. I would expect between July August there's going to be a decent poke in volatility. If you're looking at the VIX, for example, and we were trading down to 1684, we just had this just monster vol crush. Even SVXY, which is something I like to trade when the VIX does spike. SVXY is a good one. I ended up buying this thing around $35. It's up to $41, almost $42. I did bail on this thing around 39. So I went from like a 35 entry to 39. I cut my gain there, as I thought we were hitting some resistance on the technicals with the U.S. It was the U.S.-China trade agreement gap that happened over that weekend. I was out that previous Thursday, Friday. So it continues to go up. If we get another spike up in volatility, I will probably add more exposure to SVXY. This one tends to perform pretty well. I mean, from a percentage standpoint, buying it low enough, it was up 20+%. I mean, that's not bad considering it doesn't cost an arm and a leg to jump into SVXY. You're not getting really the leverage on it you would in another instrument like the SPY or the Qs, but for just a buy and hold and only setting you back about $3,500 cash, it's a lot different than setting you back $40,000-$50,000 if you're wanting to buy 100 shares and control the same thing. So different trades, obviously, but still like what it stands for, what it's been doing on this melt up. So like I said, I just think if the VIX has a run to the upside, that and it's not like a run necessarily, just a poke, just a big spike. I mean, that's a spike. That's a spike. That's a spike. That's a spike. Obviously, got out of hand during Liberation Day. Got out of hand last July and August when the market dumped after the SOM rule, and that was a weekend with non-farm. Big jobs missed. The Bank of Japan deleveraging. So I'm not sure what the why is. I don't know what the why is. Okay, but I would be pretty confident within the next 60 days or so that something happens where we push this market up. And to put that in perspective with days to expiration, how far out do we have to go on an option chain? Let's take a look at the SPY, for example. What does 60 days out get us? Well, if we're going out 60 days, that puts us into around the middle of August. I mean, are we going to do this for the next 67 days? And by this, I mean the market just keeps going sideways a little bit higher, sideways a little bit higher, sideways a little bit higher. I mean, even today, it's like we're carving out some fresh highs. I do think that the momentum is seriously waning, unless there's like a big spree of buying to push this thing to highs. And I don't want to fight this. I mean, obviously the momentum is there. I just think it's just missing like the extra little piece. Also, if we have like a catalyst that pushes the market up or even helps the market, almost capitulate a little bit higher, it would kind of break this recent cycle, right? If we get this type of move that looks like a rising wedge, and I wouldn't be selling this yet, but if we did break some lows, I think we have a quick correction territory. But if we just kind of break and get through these highs again, I mean, I could see that being a thrust. My concern is that we break the highs and then we come back in, we actually reverse. This could still be a huge bullish pattern, right? this could be a huge bullish pattern, but that bullish pattern still has double-digit potential pullback zones, and there'd still be, the question of buying the dip. So time will tell, but going out about 60 to 90 days, I would think that if this market is either going to get to all-time highs or pull back, it's going to happen in the next, 90 days. I'd say by September's expirations in the options market, we're going to see either all-time highs or we're going to have some pullbacks into like this 58 to 5,700 zone. So that's my, let's say summer forecast is if this just stays the same, and we're just melting up higher, not fighting this path. I mean, the market clearly is trying to go a little bit higher. What's been interesting on the recent price action is other than, this market holiday, that was Tuesday after Memorial Day, and the market, rallies up the entire day and spends the next 2-3 days pulling back and then rips up on Friday. Monday, we have a pullback and off we go for the whole week, right? Pullback here, off we go for the whole week. So right now it's like, because we kind of survived this, the market has been buying the dip, and let's see if that continues to be the case. I think the more time we spend over here, as long as the bulls stay above these lows, don't force a sell trade yet. And even a forced sell trade is still a, to me, it's like an option spread, just to take a little stab at the downside if we're going to get it. Okay. So all-time highs are pretty close. I mean, percentages now, we're probably within, we got to be within 3% now. We're 2.8, I mean, just over 2%. So 2.18% to hit all-time highs on the SPX. We'll go NDX. And this is probably about the same, maybe 2 to 3%. So current price about 1.72% from hitting highs on the Nasdaq. The Dow has a little bit further to go, but we are making higher highs in the Dow. The Dow, to get back to reclaim these highs from November of last year versus the January, February highs that the S&P hit this year, you have about 5% to go on the Dow. And then the Russell is also making a nice little push above the 200 moving average. Maybe some catch-up trade here in the small caps. We did revisit all-time highs. So we had previous highs back here in November 2021. We revisited those in November 2024. This one still has double-digit potential if the Russell is going to catch up. I personally don't love the Russell to the upside unless we have a bullish pattern, right? If we've got 14.44% to revisit highs on the Russell. Look, I don't know how it's going to behave, but this to me is going to be the toughest trade, is if it just goes up and there's no pullback. Now, if we did this where we, sweep these highs, go a little bit higher, pull back one more time, now that I can get my head around. That I can take a trade here, either look for the swing trade to kind of project back up to the highs again and participate with a 14, 15, 16% upside move, or I can take this renewed volatility, get my trades out of the way, have some defined risk down here at the 170 handle, and see if this area holds. As long as we hold in here, then I can still generate income. I'm still I have my shares. I'm going to keep selling covered calls. I will keep rolling covered calls and do that until I feel like I don't want to anymore, especially if we are going to continue to melt up. I mean, if I can't participate in the extra $40, $50 of price appreciation, at the very least, if I can make an extra $100 to $200 a week just selling calls, it might allow me to catch up a little bit if we have some some slowness. Where let's say this is $35 of price appreciation. Let's say it takes the entire year to do that. If we go out another, roughly 26 weeks, because we're about the halfway point of the year, another 26 weeks to go up $35 versus I could probably make on my own without having price do anything. I could probably generate maybe close to $1,500, maybe $2,000 of income. And all I have to do is see price just stay above $200. And if it stays above $200, great. If it keeps going up, I can also consider rolling out further in time and up in strikes and also increase my bottom line. So my break even right now is around 194. I have a hedge down here that cost me $500, so I want to offset that hedge with some covered calls. So I'm going to continue to roll this. My goal is I'm going to try to lower this cost basis down to like 185 or 180. And if I still let it go at 2,000, I'm still making money. And if I need a hedge, I have a hedge. It pays like 20 to 1 or something like that if I need it. But I think the big question is like, why? Why would the market derail right now? It's like we're still climbing that wall of worry. Sentiment is still higher than the normal average for bearish sentiment. Job numbers are okay. I mean, non-farm last week did beat. Average earnings were steady, but I still think we need to keep a close eye on the continued jobless claims, initial jobless claims, because it wouldn't take much to get the market to react to it. Similar to what it did last summer, when we saw the uptick in unemployment and the miss in non-farm numbers, the market reacted very aggressively to the downside and very negatively. And I could see the market kind of doing the same thing. This week, for example, we have CPI data on Wednesday. And if the market reacts adversely to a higher inflation print, so year over year CPI, if we print, previous was 2.3, forecasted 2.5, that's headline CPI. So are we going to see mainstream media say, hey, look, inflation is higher. Inflation is higher. Is it doom and gloom? Is it more get ready for higher inflation? Is the talk of stagflation? Maybe, I don't know. But the news cycles they're not derailing anything right now. Price is not derailing anything right now. So key levels I'm talking about, that's why I mentioned that in the thumbnail today. I mean, key levels for me, just watch these recent lows. Watch this low last week with trust. This is Elon Musk and Trump drama. Watch this low as well. Watch this low as well. I mean, until the bears start clawing away and taking out those lows, I think even if this market just goes down a little bit or sideways, up a little bit, sideways, it's just trying to get back to these highs. Trying. So that's probably the course for right now. I mean, oftentimes you can trade path of least resistance, and that would be pretty darn good, if you ask me. Okay. And yeah, that's a good point. No sailing aware, just holding my longs. Yeah. I mean, I'm kind of doing the same thing outside of actively selling some calls, which is helpful income generator. But look, I'm up another 30 grand for highs this year. And I said this a couple weeks ago. It's like, look, I may not actively participate in this monster melt up, but my portfolio is tilted enough so that if we do get to all-time highs, I'm probably going to see like 280, 290, maybe even 300K in profit. The nice thing it is running today, I just went to see like where's the source of my P&L coming. IBIT's had a nice little intraday move. I'm up about 7 grand in just the Bitcoin ETF. MicroStrategy's up $5,300 on just a nice little move back up. Baidu's had a decent run today. It's up a couple of dollars, so $4,500 there. Pfizer, who knew it? I mean, I've got to do a diagonal spread there, but I need to add another leg to it. I'm up about 4 grand on Pfizer. Tesla back up to $300 after having some of the drama and fallout last week. I'm just going to keep selling calls in this one. SLV, we're now starting to break some highs. SLV is looking really good. So top of the food chain for my portfolio today is doing well. I like all these positions. I mean, Bitcoin, MicroStrategy, which I get as a proxy to Bitcoin, but I'm still in both. I'm generating some income. I'm speculating on MicroStrategy. I'm positioning in IBIT. I still like China. I really do like Alibaba, Baidu, JD. That's kind of about it for my exposure. Baidu is cheap enough that even if we came back down to $80, I still like the technical support. If we started to go back up, we had recent highs around 104. So let's go to Baidu for a second. I mean, I look at the technicals here. We're holding these 2022 lows. If this starts to get a bit more of a bid to the upside, I mean, these recent highs are 105. This kind of technical level, I'd like to say, you know what, I'm willing to dump the shares around this 116 handle. But even more so would be, and I don't know if we're going to do this aggressive move like so, but man, I'd love to say that this is like a target one, clear half my shares, and then let the remainder run up here. So if I can take partial profit and then dump the whole position like a 150 to 155, that to me is a really nice technical price target on Baidu. So anyway, but it's just doing this. I mean, and maybe it's more chop. Maybe it's longer. Eventually, this carves out a bottom that works its way back up. So I'm still holding shares, but I'm looking to see if we have any recent highs that can be tested or taken out. Okay. Josh is asking about AJG. Okay. It wasn't on my radar today, but let's have a look. Arthur J. Gallagher. I mean, that's a big drop for the last couple of days, isn't it? So this started to really top over early June. Any type of catalyst here? Did they go? I mean, they still paid dividends from what I can see, right? Just go back, dude. Just one. Shoot. Back to that workspace. All right, AJG. I mean, maybe it's overcooked. Let's take a look at the fundamentals. So Market perform, maintained. Average volume is okay. Dividend is not really a thing, 0.8, 0.8%. Nothing super exciting there. I hope we can meet July 4th deadline on tax bill. Well, there's another why, right? There's another why potential. What would be the catalyst? Maybe the U.S. can't meet the tax bill. Maybe the tax bill is not going to pass the Senate. You know, I don't know. I guess it depends on if Democrats and Republicans can't pass it, can't get along, no bipartisan anything. Despite the $2.4 trillion it's going to add, it's probably something that the market needs to stay higher. If they don't pass the tax bill, what's the waterfall of risk, right? They don't pass the tax bill, then what happens? Do we have a debt ceiling? Do we have a default? Do we have Trump just going nuts on social media? I don't know. I mean, that stuff is never in our control. I just think that's why I'd price out some risk, because if the market's going to have a volatility spike, I want to be prepared for that, and that's when I would be looking to deploy. I mean, I think I raised between some of the trades I closed off today. I closed out a trade on the Dow, so DIA closed out 2 trades at a naked put in a 111 trade. I had 2 winners on my pinch point scanner today. I do have a good looking trade on Airbnb. I'm probably going to take some profit on. I'll talk about that more in classes this week. Same thing on CrowdStrike, looking good for some full profit. Those are up like 80+% of my max credit. So I could just start taking those off and getting the buying power. I took off a 111 trade on IBIT as well. So I had like 1.7 this morning in option buying power. Now it's 1.8. So I mean, keeping plenty of cash at the ready in case I need it, and hopefully there is an opportunity to deploy it. So anyway, we'll keep going. But let's take a look at AJG. Maybe range bound. If I look at it fundamentally, let's go to simply Wall Street. Let's go AJG. I mean, Snowflake looks pretty good. Maybe some risk. Forecast to grow earnings. I mean, that's not bad. Insider selling. Okay, I get it. Price to earnings. A little pricey. Price to earnings. I mean, this is probably not the best thing. So we're trading at 318. Fair market's 297. 297 is actually below this April low. Well, if it was fair market value at 340, 350, and it just came off those levels, then I'd be more inclined to maybe position for this. I mean, probably a tight risk to see if this 200. If this 200 moving average holds, a little debit spread would probably be fine. If it bounces right there and it holds, that's a cheap trade, if you ask me. I mean, here's an example. So we're trading around 318. Let's look at the option strike. So AJG. We have earnings on the 24th. I mean, you got to go either pre-earnings or, I mean, if I did pre-earnings, I do probably more of a credit spread. If I did post-earnings, I probably do a debit spread. Let me go pre-earnings. We're trading at 318. This 200 moving average is 309. If I did a 310 by 300, I mean, let's do this at the money. Almost $4 for an at the money. So if I did this trade and try to get filled for, 350, not a bad trade. I mean, as long as rule of thumb is you're collecting about 33% of the width. So if you're willing to risk, roughly 650 to make 350, that's not a bad trade. I would just try to give this a little bit more wiggle room to the downside in case it's wanting to, come back and test the 200 moving average and also offer that as a buy opportunity. Make sense? Omar, I have no idea. I mean, anybody that asks me how long, I have no idea. Omar, you're my symbol. Baidu. I mean, Baidu has been a annoyingly, support is in around $80, but why won't this stock go anywhere? Look at the difference between Alibaba and Baidu. It's like Alibaba has ripped multiple times the upside, and now I'm wondering to see, will this one head back up into highs again, and we just have this big channel. Baidu is still just kind of building off these lows. So, I mean, I think the key for me is I don't really care how long I have to hold it. I would hope it's not more than, 6 months to a year. But here's what I will say. If US and China can play nice in 2025, China stocks probably do fine, right? If US and China can't play nice, I don't think it's just China stocks that get hit hard. I think the US market and the global economy will also start to price in. There's a lot more risk out there, and things will maybe get a little bit nasty. So I think it's probably for the best if we keep this US-China negotiations, right? We supposedly last week there was a talk between President Trump and Xi. This week they're supposed to be meeting, at least representatives meeting in London. Ultimately, this whole trade war is about US and China figuring out what terms they can come to agreement on. So, I mean, technically speaking, I like the stock. I think if US and China can play nice, this stock has all the potential to get back to 105, 116. I'd love to see this thing get back to like 150, 155. That's definitely a bigger hold, but I mean, this to me looks like a big rounded, like this is a V bottom. This is a big rounded bottom. So, if you're watching this price, like this is probably the trade. If it coils and coils and coils and coils, eventually it's ready to go. What I don't want to do is try to call the top, because if this thing is going to coil like a falling wedge, this thing might squeeze all the way up to 150. And the last thing I want to do is sell calls, right? If I'm long the stock and I can hold on to it, maybe that's the best thing for me, is just hold on to the stock like here. This was a run, pullback, run, pullback, run. Look at some wave structure, try to get like a 3 to 5 wave move, and just look at all this resistance. I'd love it to hit that level, 150 plus. I mean, my break even's in the 70s because of all the options I have been selling. So anyway, unless price aggressively breaks $75, I think this one is a bit of a hold, and look to see if this thing will make a squeeze to the upside. That's my outlook. Okay. So Josh, my thoughts on the AJG would be like a 310 by 300 credit spread, and trying to collect like $3.50 to $4 on that. That would give price a little bit more room to pull back. If you don't want the assignment risk, then maybe switch around, do a debit spread instead. Paying $6 for a debit spread to make 10, you're paying a little bit more than what you want. But I think the credit spread to me is a better trade. If I get assigned, I'm going to dump the shares. Okay. All right. What else are we talking about here? So let's check currency strength. Let's look at the heat map today. So New Zealand, Aussie on top. We got Swiss and dollar on the weaker spot. That's fine. Let me check some currency pairs. Still waiting for a pullback to buy my Aussie CAD. I'm just holding Aussie Swiss, generating some swap here. Aussie New Zealand, I'm still looking to buy in. Aussie dollar. Let's take a look at the DXY first. Dollar index. It's interesting. Like the dollar index looks a lot like the bond market to me. Like DXY, TLT look very much the same. So, let's look at the low here. This low was around April 21st. Look at the low on TLT. April 20, that's May. Where's April 21st? January. Oh, I guess I was way off. Is that right? Did I look at the wrong date? Hang on. That low, yeah, April 21st. When did this thing bottom? So the post-Liberation Day was April 11th. So in here, I guess we bottomed the US dollar. We kind of bottomed. It was not the same correlation, same day. There was your, basis trade breakup, your post-Liberation Day debacle that, TLT came right back down, and it tests the lows. This is another one, I think hitting support. Okay. Support here that's not necessarily holding. Support here that kind of better hold. If we start to see like this slow bleed on TLT, that's not a good thing. That's going to be essentially a 5-year drawdown in the bond market. And I guess the switch is like if and when the Fed cuts rates this year, the market's anticipating 2 cuts this year, like September, December. So if the Fed cuts rates twice, do yields actually go down? Right? Like if the Fed cuts rates, do yields go lower and bonds go up because of it? Remember, that's a correlation. If bonds go up, yields go down. So it was the opposite price action last September. The Fed cut rates and the bond market yields went up. The Fed cut rates 100 basis points. The bond yields went up 100 plus basis points. I hope that's not the case in 2025. I mean, that's breaking like a 40-year relationship. Usually, if the Fed cuts, the yields follow. And I ultimately, like, I don't know how firm Jerome Powell and the Fed is going to be this year. I think they want to cut rates. I just think that if they cut rates and the bond yields react the opposite and they rally, then I don't know. It just puts us in a really interesting pickle where it's like cutting rates doesn't help anything. You know, it's like, why cut rates? If we have sticky or higher inflation, why are we cutting rates and the bond yields do the exact opposite? That's not going to help anybody. So anyway, we'll see. But I've said this now for the last couple months. I mean, I'm actively trying to get rid of TLT in my portfolio. So the way I have it set up right now is a diagonal spread. Here's just one account look at it. So if I go TLT, TLT. So I have the 65 long call and the 89 sell call against it. So it's a diagonal spread. This gives me $24 of potential credit, and my net debit on this thing I think is in maybe the teens. Let me check. So I have a debit of around $20, like $20.30. So my break-even price is $85.30. This is out to the end of the month. I'll probably do another one, depending on what happens in the bond market. I mean, if TLT is going lower, then I'm just going to try to get closer and closer to break even. That's okay. I'm trying to give myself some upside. Like if we get called away $89, then okay, I make $3.70. I've got this on 4 contracts. I make just over $1,000, but I have this on quite a bit of my accounts. So what I'm trying to do actively is just I want to get rid of the call side. Like I want the call side to get called away. I want to take this trade with an $89 strike. I want to pair it with my long 65, and I want to get out of this trade for $300, $400, $500 a contract, and then move on. I don't want TLT. I'd rather keep gold. I'd rather keep silver. I'd rather keep Bitcoin. I'd rather have other assets versus the bond market. I just don't love it. Okay. All right. Got a little bit more time here on Spotify. This actually I don't know. I might get lucky on Spotify. That'd be a sweet little move if I can get lucky here. So I'm trying to see if Spotify will work its way to 675 or lower. I've got a profit trap at 670. My break even is 680. So if we get to 675, that actually turns this into like a $750 winner. But if we're above, if we're staying where we are right now, like I'm going to take a 1% loss. So it's about $2,000 on the trade if I'm dead wrong. Hopefully price will come back and at least find this inefficiency. I'd like to see a little bit of a sell-off before the 620 expiration. But I don't know. This market's melting up kind of oddly. You know what? Actually, oh my gosh, I just looked at this. Spotify. This thing has a huge bar count, by the way. I think I need to extend this trade. This thing, this is ridiculous now that I notice this. This is a bar count that is a monster. We should be coming back. We're at 447 bars on Spotify. I think we're going to come back and find it. Let me see if I can work something here. I might, maybe I can roll this thing out like another cycle. Let me try. So the put fly is fine. I'm up about 90% of max profit on the put fly. The call fly, maybe I can roll this one out. This is going to be a tough one to roll. Usually the broker doesn't let you roll like the whole butterfly. So what I'll probably have to do is maybe roll out like the trades individually. Son of a biscuit. I just don't want to book a loss. I want to roll it out for a net credit. Let's find out. So let me see. Let me take the 660 by 670. So I'm going to roll this. And I want to go. So this one down a contract. This one down a contract. There. Okay. So I can keep the 660 by 670. This is a bull call spread. So I can roll this. Let's go to July. See what this gets me. So if I roll this out, I can still get 90 cents credit on that roll. I think it's the bear call spread that I need to roll. That's the 670 by 700. Is that right? Yes. So that's probably the more prudent roll right now. All right, so let's take the 670 and 700, see if I can roll this. So I don't want 2 contracts, I just want 1. Okay. So if I roll this out to the 18th of July, this one, okay. So it's going to ask me to pay for this debit. Fudge muffin. So I'd have to pay $1.20. It gives me more time. It just ends up digging the hole a little bit deeper if I'm wrong. If price still stays above 700, then I'm just wasting money. I don't know. Maybe the best thing is just to move on. I mean, it's not worst case. I mean, I don't know. I could just get out of the trade now and just take the loss. I'd cut about half the risk on the trade and not worry about it. There's still 11 days, which this is like crunch time. This stock either drops, $20 on me and gets me back into profit, or I'm going to see more risk on the trade. I'm getting into that time window where time is of the essence. I need this thing to really behave in my favor. So honestly, the best trade is probably just to dump the loss on the call fly and take the profit on the put fly and just eat it as is. I did this trade collectively where I have risk of about, I mean, it's $3K risk minus the credits. It's like $2,400. I'm upside down now, $900. I think this one's okay just to get out of. So I'm going to leave the put fly for full credit. I'm going to take the, let's see, I guess I can do this. What am I dumping here? If I get rid of the butterfly, I'm taking a loss of, yes, it's like $900. That's not bad. Versus trying to get too fancy with this thing and taking off like, well, I'll keep the 660 by 670. That's a debit spread. That's going to be worth $10. What I pay for that trade, that was a, out of the money debit spread. I mean, I paid, I don't know, like $1 for a 10 wide. So if I just dump the call spread, let me see. This is like 30 wide though. I got to be careful on this. So if I dump this trade, let me close this thing down. So if I dump the 670 was if I take this down to 1 contract. Okay, so I'm losing essentially, I mean, $1,900 there. I get the 10. I mean, it works out the same way. So anyway, it's better if I just dump it now, take the small loss. We're down $800. I'm going to take this loss on just the call fly. So this is my project options edge. Let me see if I can get out of this thing for like $950. $950, no, let's go $975. I mean, $10 is fine. So let's go $990. $995 is just, actually, you know what? Let's go $992. I'm going to penny this thing up until it gets filled. I want to get out of this trade. $995. Come on. $999. Son of a biscuit. All right, let's just take the 10. 10. Son of a B, man. I'm above the mid price now. Let's go. 1020 not filling. 1025. All right, so pulled in $1.50. Let's go 1030. 1040. Come on. What's a guy got to do to close this trade, huh? 1060, not taking. 1070. This is a 9. I'm taking a little bit bigger hit than what the platform shows, which I don't love. 1080 not filling. What the heck, dude? Come on, man. All right, I'm going to go in 20-cent chunks now. 1120. Having some funny business going on. 1140. All right, got filled for 1140. So net on the trade is this. I'm going to update this for my Project Options Edge. This one needs to be updated. So Project Options Edge, going back to search for Spotify. There's my trade. So this is the trade originally. I did $1.50 on the call fly. I did 75 cents on the put fly. So the $1.50 credit. Here's how the math works on the trade. So 1140 debit minus 75 cents minus $1.50. I'm losing 915 bucks in the trade. Now, 915 is my loss, but my max risk was around $2,600, $2,700. So I'm saving a decent amount of risk. Price is already, it's at my max pain point. If we go higher, it's just max profit or max loss, which would be like $2,700. I'm just going to save the risk. So I'm going to do a quick update here for Spotify. Trade management update, Spotify. I'm closing the butterfly call fly or the call spread for $11.40 debit. The trade result is minus $915. Net loss. I'm keeping the butterfly put spread running to expiration for full 75 cents credit. Spot needs to drop to 680 or lower by June 20th expiration to be break even or better, rather than holding on for 11 days and hope price hits that level or lower. I'll be responsible and take the less than 1% loss. Okay, so I'm just taking a loss. It's about a point. 915 out of a. It's a 0.2% loss. It's not really a big deal, but it's enough. I'll take the trade, move on, lose $900. It's a lot better than losing $2,700 and move on. Okay, so that's an update for Project Options Edge. I'm going to update this in my tracker as well. So this one was spot. Yep, so the double broken wing. So loss of 915. Keep put fly for win. There. That's the only loss I've taken in that service. We are, I don't know. I mean, we're like 13 for 13. That loss is totally fine. We've had some really good winners. And yeah, I mean, so far we made, I don't know, I probably made $6,000 or $7,000 in that service and just taking a little hit, no big deal. Lee, how from your master classes? Lee, I feel like you're asking me 2 weeks late because we've been doing classes nonstop for 2 weeks. Not last week, but the week before. We started on a Wednesday, went Wednesday, Thursday, Friday, did it 5 days last week, doing 5 days this week. So I'm running master classes for Pinch Point Scanner every day this week. Yep. And again, so if you're getting the scanner, the way the service works is you can get the scanner and you can upgrade the scanner to also include alerts from me, and those alerts are good for 12 months. But it's scanner first. You want the scanner, you can have the scanner. You want me to trade with you, then you go scanner, upgrade to my alerts. Okay. After a year, my time isn't free. You got to update, upgrade or just renew my alerts for another year. But I will continue to do classes for that group. So what I'm doing now is like a broad, everyone that's in the scanner gets my master class. Everyone that's in the scanner, we're pricing out trades together. That's going to stop this week. After this week, everyone that's going to get my master classes, everyone that's going to get my recurring trade or my recurring live classes are going to be everyone that's upgraded to my alerts only. Okay. So if you're in the pinch point scanner in the dashboard, consider upgrading to the alerts so we can continue to have those ongoing classes together. Right. So because again, we've done a lot of time together, a lot of classes together. You can see the way I, find a trade with a scanner, price out the options, try to find a fair trade. We just hit 2 for 2 today. Debits were automatically, I took the debits a couple weeks ago, automatically hit the take profit from the broker, closed me out at my 50+% winner, and moving on. And we have, I think total right now, we are in 18 trades. 2 have been closed out for winners. We have like another 10 that are in profit right now that are like 20, 30% profit. I just want to see if they'll go to my take profits that the broker already has. So it's a really easy scanner to just have great trades fed to you. And then from there, the only thing I'm doing is I'm taking the scanner trades and I'm putting them in my broker platform to see, do I like the way the option strikes work? And that's the only thing I've had where let's say I find 10 on my scanner and I'll take 1 or 2 trades live because the other 8 had like $5 wide strikes that I didn't like the pricing. Or the expiration was too far out. It was like going out 100 days versus going out 60 days. So I'm just kind of picky on how I want to price things out, but pretty good. Yep. So just keep that in mind with the option for pinch point scanners to get in the upgrade. So that way you have the scanner upgrade with my live alerts, and you get those alerts for a year, and you can keep renewing those as much as you want to. But I will continue to trade live with that group. Probably either a video update every week, or we'll sprinkle in like a couple live classes a week. Probably 1 live class a week, just to make sure like we're finding trades. We see the same kind of scans together each and every week. Like today, for example, we had a lot of hits. We had like 26 in the go filter, and we priced out most of them. And then we had a bunch that lined up for the first time in the get set filter, and they're pretty new. Like Palantir's new, Hims is new, Nike popped up last week, Walmart popped up last week, Wells Fargo, Bank of America, JP Morgan. Those are all stocks that popped up this week in my get set. So we've got some really good trades lined up on the pinch point scanner where you give it a couple more weeks and see if the market's still willing to consolidate. I think this market's ready to make a big move. And on top of that, think about the pinch point scanner finding the SPY or the Qs or the DIA or the Russell, like those indexes, when they're coiled and pinched and ready to move, we're going to have like a broad market reaction to it. So there's certainly a time to position for, volatility expansions. And that's kind of what I'm noticing with more and more kind of mainstream stocks popping up on my scanner is eventually, this look here, I'm going to keep it on this Spotify just to torture myself. This is what I do. If I take a loss for $900 by the 620 expiration, I'm going to look back and see what would the result have been. Because if this goes down to 680 or 675, then I'm like, son of a biscuit, that would have been a $700 winner. But if it goes back up to highs again or it stays above $700, that's a $2,700 loser. So, I'm not going to beat myself up too bad, but I'm saying like I do like to torture myself where I'm like, well, what would have happened if I just rode it all the way to expiration? We will see. But considering my spreads look like this, it was a broken wing butterfly here and a broken wing butterfly here, and price went over. I mean, this is max risk, right? So over the 680 handle is max risk, and we were all the way up to like freaking 720. So I mean, it's got to really fall, $30-$40, which it can happen, but that's a lot to ask for in 11 days. So I think I'm doing the smart thing. That's typically how I'm going to justify it. I'm doing the smart thing. I'm doing the responsible thing. I'm taking much smaller loss, and that's good. That's probably the right decision. Anyway, what I was going to say is the SPY. So if we go pinch point scanner and go to all stocks, and I look for the SPY, okay, if this is in any way, shape, or form popping up in my filters to get like a get set or a go, I want to be looking to trade this thing. So is a SPY in a pinch right now? SPY just got into a get ready phase. Okay, now get ready is just the very, very beginning of this kind of coiling process. So the nice thing is that it's starting to set up, but you and I both know that we've been melting up higher, drifting higher. This really hasn't been, it's not been sideways, right? It's like just slowly higher, slowly higher. To me, what this tells me is this market is either getting ready to, like a volatility push to the upside. So we have like the squeeze up to like all-time highs, and then from there, that's where I'd like to look for some sell opportunities. If I want to pick a direction, I'd like to fade, all-time highs with a defined risk trade. Not something I'm like, I'm calling the top. I'm not calling the top. That's a stupid trade if you ask me. But what I would do is I would consider some type of inexpensive hedge at the highs where maybe I risk $500 and it pays me $2,000, $3,000, $4,000 if we come back and fill that US China trade agreement gap. Something like this. If let's say the SPY were to hit these highs, okay, hit the highs and then turn back to fill this gap. Well, if I can get a trade in here that offers like a 5-to-1, I'll take the trade. As long as I'm risking like about a quarter, 1%, and this pays me maybe, 1 to 2%, I don't mind taking that trade. Now, this would be like a 3 to 5% pullback, but if I can still portfolio position for, 1 to 2% gain, that's worth kind of protecting the portfolio. And if I'm wrong, I sacrifice 0.25 and the market just keeps freaking going higher. That's fine. I'm tilted that way anyway, you know. But anyway, I think if we're getting coiled and we're getting it popped up with my pinch point scanner, I could see this market, squeezing higher and then volatility actually goes somewhere. We have, this little run up move and then market makers kind of keep it within a range. But yeah, I could see like a little poke to the highs. And I don't know if there's going to be just crazy amounts of profit taking or just based on technicals. We just fought our way back, I guess. So anyway, time will tell. Or maybe this market doesn't care. I mean, honestly, it's like if I sell something here and it doesn't pull back, and it's like, guess what? If you give this market 1 to 2 years, we're going to fill this stupid gap. I'm very certain we're going to fill this gap. But that timeline is crazy. Like for me to call a top here and say, well, it's got to happen it's got to happen like the next 6 months, the next 12 months. I'll give myself plenty of time. But, maybe this market just doesn't care. I do think there's a buyback blackout window that's coming like in the next couple of weeks. So as we get into July's trading, we've got a lot of stuff that's stacked up, right? We've got a blackout for stock buybacks. So basically, like a trillion or two, it's like $1 or $2 trillion of buybacks that were exercised these last like 4 to 6 weeks. Those are gone. So if we can't have forced buying, we can't have forced buybacks. Earnings season is kind of dried up for a little bit in the summertime. We get through July, we have a little holiday, and then we have our 90-day pause. Deadline is up. Like, does it matter? Like, what if we don't have a resolution on this whole trade war? What if, again, and nobody's thinking that in 90 days we're inking these crazy, like, long-term trade deals. I just wonder if the U.S. kicks it down the road again, which is very possible. We just say, yeah, well, we're still going to get more terms or time to negotiate. So here we go, another 90-day pause. And the market might love it and the market might melt up with it. Yes, no, maybe so. So I just want to be careful on how bearish I want to get for any type of planning to trade the downside. It's like, you have to remember what happened during COVID, right? Go back to COVID. What did the market do? It never stopped. When we got back through the COVID lows right here, did this market give a crap? I mean, if you think about this, treat this like this is the future of 2025. What did the market do? Well, we had our liberation day. The market got back above the 200 moving average. It drifted higher, pulled back to it, and then proceeded to hit all-time highs. Did it stop? No, it went higher. Now it did pull back here, and it did pull back here. but we continue to melt up, even through the next year. Now, I don't know if 2026 is going to be as generous as it was now because our earnings, we're like 22 times earnings, right? After this pullback, we were at like 15, 16 times earnings. And I think when we got back up to the highs, we were at like 19, 20 times earnings. So we're at a more expensive stock market right now, Anyway, and here we are, just crazy high. Here's 2022's correction. Here's 2023's bull market. Here's 2024's bull market. Here's now. So there's no reason or guarantee that the market has to go down. I mean, there's just not. Now, I guess if the Fed was really, really dovish, maybe it might help. But the Fed's not really dovish right now. The Fed is maybe cutting 25 to 50 basis points this year, and we'll see what the bond market does. 2020 was a very different animal. We pumped $3 to $4 trillion, $6 trillion globally into the markets, and somehow it's still like in the system. The markets can do whatever they need to do. I think all-time highs are going to be easier to flow with. I think that if we do have a dip, here's the thing. Do you want to time this dip, or do you want to just buy the dip? What's easier, right? Because how frustrating is it to do this? You time the dip and the market just does this and does this and does this, and then maybe it dips back to the recent highs, and then it just gets picked right back up again, and it keeps going and keeps going. And maybe this market is going to be super slow, but super steady, super slow, super steady, no real pullbacks. If you're trying to time that high, you're like, I need volatility. You don't get it. That's a paper cut, and the more you get bearish on that stuff, it's like the paper cuts are annoying. So I like I said, I might take a stab at it, like either from this level or, who knows, maybe at a, I don't know, maybe up here, maybe like my 650 to 660 level. I'll go back to my blank workspace where we wrap things up here for a closing bell. Markets are essentially flat in the day. We're giving back the last 5-10 minutes. I'm seeing prices fall a little bit. Let me go to my blank workspace here. Just go to the monthly chart. All right, closing bell. Tail of the tape's pretty flat. So here's my monthly. Okay. So even if you started from the 2009 low, if anybody's familiar with plot and fibs, low to high pullback, 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 low to high pullback. Okay. I look at it this way. You start from this COVID low right here. This is the low that I would start at. This is the high. That's my swing. This is 1, 2, 3. There's two ways I see this playing out. Either this is the 4 that continues to head up to the 5th wave completion, which is anywhere between about 6,400. If there's some more momentum to this, then possibly 7,000. That would be like, and that's a generous window to the upside to give this market room to drift to 7,000. Okay. Wave 4 also can be a flat pattern. So we go 1, 2, 3, 4, 5. So what does that look like? If this is a wave 4 flat pattern, that would look like this: high, low, equal high, equal low. Then the market still takes off to the upside. This is why if you're in any of my services, I've talked a lot about this a lot. I don't want to be forcing trades at these highs in case this market is going to go sideways, right? Going up and down 20%, it doesn't break anything. It's not a bear market. 20% in this volatility phase is just noise, and ultimately the market, like, look at how good of an opportunity that is to stay bullish and not break any clean structure, not break any key structure. Because if this support holds, like this low from April holds, this market can stay in a flat pattern as long as the bears don't break this low. If we go back up to the highs again and clear this level, then that's where I think we're getting the 65s up into the 7,000s. And like I said, I hope there's a chance to trade that as opposed to higher, 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 higher. Eventually, when this runs out of steam, it's going to be an ABC correction right back to this trend line again. Whatever that looks like percentage-wise, I'll try to participate in some way, shape, or form. But again, the trend line that I'm watching is this trend line, this trend line, this trend line, this trend line. If we pull back to this trend line, it's still a bull market. But if it breaks over here and then we spend some time, fading the market, this is where the bear market gets very, very scary, because this side doesn't look good for anybody. This is where the 30, this is where the 40, this is where the 50% correction can come. Okay, and I'll just ballpark it. Let's say we get up to like 7,000, okay? And then we drop back to the outer trend line. I mean, we're talking probably a 30 to 30, I'd say 30 to 40% correction to hit this outer trend line. Not a lot of traders going to have fun in that environment. I will survive it, but I'm not going to have fun doing it, and I'm going to have some crazy low risk, high reward type hedges where even if the market does drop 40%, I'm hoping that my portfolio is protected 50, 60, 75% to the downside. Because if I can churn out, 10, 15, 20% gains while the market's down 30%, I'm very happy with that. So anyway, future talk. So as of now, path of least resistance is as long as these lows don't get taken out, keep your eye on these key levels, right? So that's my blank monthly chart that's nice and clean. I do expect the market to try to get up towards 64 to 6,500. This is SPX. Could we melt up into the 7,000s? Sure. And as we get into the end of this year, get into 2026, all I'm going to do is, I don't know, put on some really cheap hedges. That's all I can do. If it just wants to melt up, it's like I'm a fool for trying to be a bear here. Everyone's stupid for trying to be a bear here. Everyone that's been a bear for the last 3 months, swearing the market's going to come back and retest the lows, and this is worse than everyone says it is. The market doesn't care. And if the market doesn't take out this low or this low or this low, and it just keeps going higher and higher and higher, then clearly the market doesn't care. Okay. So if we do take out these lows, then let's pay attention. Let's understand there's levels to buy some dips. But if it doesn't take out the lows and it just keeps drifting higher and higher and higher, just don't fight this thing. A couple inexpensive hedges that you can sacrifice along the way is okay. It's there if you need it. But if you don't need it and the market's going to keep going higher, the last thing you want to do is fight a market that's destination, maybe 6,500, maybe destination 7,000. Like, why fight it? If you were more confident where the next 1,000 points are going to be, and it's probably more to the upside, why would you be so adamant about being bearish right now? I'm not. Like, I shouldn't be. So I'm looking at any decent dip, like like I said, 3, 5, maybe 10% pullback, which seems a lot. That could be a nice little spike in volatility. I don't know the reason why it would happen at this point, unless Trump is going to be very vocal again, or unless we start to see some nasty narrative in trade talks again. I don't know. I mean, is Musk and Trump going to break something? No, I don't think so. It's just noise. I mean, the markets care about earnings. The market cares about forward guidance. The market cares about employment. The market cares about Fed and monetary policy right now. That's about it. Government, if we pass this big, beautiful bill, clearly the government's going to be spending. That's more of a melt-up catalyst than it is a fall. I don't see the markets falling because the government is going to spend more money. Spending more money is what got us through this 4-year melt-up in COVID, post-COVID. So passing this tax bill is likely going to be bigger gains for stocks. I'm just hoping that we can get a dip or a pullback to participate in higher highs, as opposed to this just keeps going. And it looks a lot like COVID. This is your COVID crash. This is a little pullback here, and it just keeps going and going and going. Eventually it'll correct, but there may not be the need for a big deleveraging. Okay. All right. Imran from India, thanks for watching. All right, but I'll let you go for today. Thanks for being here. We'll come back and do it again tomorrow. Pinch point scanner update. So we had class today at 1:30. That class will be recorded in the classroom. We're doing classes Tuesday, Wednesday at 4 p.m. Eastern time, Thursday, Friday at 1:30 p.m. Eastern time. A lot of live trading on that Thursday, Friday, just like we did today. I'm combing through the portfolio today, took some winners, raised some more cash and capital, waiting to deploy, taking some good stabs, selling some covered calls. And, daily profit did its thing. Waterfall income, we put in some fresh trades today. We got 4 winners running right now. 2 we just took to add to 6 to open positions. And that's it. We just fight the good fight as always. Okay, so for this week, CPI and PPI data come out Wednesday and Thursday. The only thing I'm really paying attention to this week is watch this low right here. Watch this low right here. If the market is not going to break them, I think the market's just going to try to keep grinding higher. Right? I know the CPI data might, roll this thing over a little bit. If it does, that's okay. If it does, then maybe there's a pullback that I've been waiting for. I'll position for it. Okay. because ultimately I don't think the market cares. Like we've had higher inflation, we've still gone higher. We had 9% inflation, the market still went higher. We have 4% inflation, the market still went higher. We have 2.5%, market still wants to go higher. You know, so unless the market's sensing like we're going to go hyperinflation mode, I don't know. I don't think we're there, not yet. So watch your prices, watch your lows. That's the key levels for me in the S&P. All right, I'll let you go. I just said, let me see what this is here. Oh boy, here we go. Dr. Doom, known as Dr. Boom, believes the U.S. is no longer headed to recession, but instead a period of huge investment. Somebody just tweeted top. Yeah, we'll see. I mean, when sentiment shifts aggressively bullish, then yeah, I'm certainly contrarian on that. It's like because now it's like why now? Why would you be pivoting now and say like there's no recession? It's like, well, why the hell didn't you say that? When you had the courage to justify like this was noise back in April. Now that we've had a 20+% rip off the lows, and you're going to say, the U.S. is going to be fine. It's like we're 24% off the bottom, and now you can say like everything looks okay. Well, yeah, because we've been up above moving averages for the last 3 weeks. This market. I mean, this market could still pull back to all these moving averages right here, and still look very, very supported. Right? This market could go even higher and still pull back to those moving averages and still look very well supported. And maybe we just don't see any volatility. That's the one crazy part is like, I think the VIX should spike up, right? I think the VIX should spike up, and it probably will in the next 90 days. But let's go back to 2017, right? 2017, guess what the market did for the entire year? Okay, let's go back to 2017. This was the VIX in 2017, also under Donald Trump. This was all the VIX did for the entire year. Nothing. So what if that's 2025? After this, self-inflicted volatility spike, pivot hard, let's say that's our VIX. I mean, there's little bits of ventilation here, but not much. And that to me would be if we matched any like kind of rhyme of this, if you will, like a parallel to that, we would just have melt up, right? Melt up, melt up, melt up. So I'm just saying, like, I think we need to give the market all the credit in the world for how it can just shrug off so much uncertainty, climb the wall of worry, and probably continue to do so. And I think the pain trade is honestly people just missing out. People that are so worried and so fearful and so uncertain that they just don't participate, and the market just goes up another 10, 15%. And then we have a 20+% year in 2023, a 20+% year in 2024, and maybe a 10, 15, 20% year in 2025. I don't know if that's ever been done. Usually, 2 plus 20+% years are still met by double digits. Like we could probably get double digits this year. So that's what I'm saying. Don't fight it. A dip is good. A dip is good. Position for it. I'm looking at incomes. I'll probably add some more shares, but don't fight it, man. I don't know. Just don't fight it. And if this is going to reflect anything like 2017, maybe this volatility is just nothing more than a little tiny spike here and there, but it's just really boring. And the market, meanwhile, just goes higher and higher and higher and higher and higher. So I don't think Trump and co want to break anything at this point. They tried, they failed, they pivoted hard, they saw the consequences of a systemic break. So I think right now it's like stabilize the bond market, stabilize the dollar, let equities do their thing, keep the narrative very tight, pass this bill. Yes, we understand we got to find a way to grow through it right now, whatever. They can justify how they want. I'm saying, watch price, watch the VIX. To me, this is a dip. If we get a dip, I'm going to buy it. I'm at least going to take option trades to give me a lot of margin for error. Okay? All right. J&D, how much are the alerts? So if you want to take a look at my alerts, anything I offer, I'll give you a Discord link here that'll be good for 30 minutes. So here we go. Here's my channel. So my Chris Pulver Trading Discord channel. I have, yep. So let me go into education updates. So right here, so if you're in my channel, you got education updates. You also have affiliates and discounts, private instruction. Yeah, it's just going to be here, education updates. So these are, let me update this really quick. I thought I updated this weekend. So edit message, and this is newsbreakers, project options, edge, pinch, point scanner, plus alerts. Okay, so these are the services that I run. This one I trade every single day with members. This one I trade every Monday with members. This one I am looking for asymmetry alerts through the week. It's a bit directional. We trade a lot of like 0 and 1 day expiration for like, big upside potential. I take a lot of like 100+% winners, 200+% winners, 130% winners. I don't win every trade. I mean, I'm winning like 60% of those trades, but the winners are way, way, way bigger. And I try to find those trades, once or twice a week. Newsbreakers. This is mostly like catalyst driven, so like earnings, big breaking news, and then I try to position something in options. It's been a little quiet the last couple of weeks. I just haven't found a good trade that I like. This week there's a couple I want to put on. I think there's Adobe, Oracle, Chewy, a couple other earnings plays I might look at this week to try to get something together for newsbreakers. Project Options Edge. This is a complete discretionary service, which is I've got a lot of ways that I can trade to make money. Sometimes I like to invest and sell covered calls. Sometimes I like to build out ratio spreads. Sometimes I like to do whatever strategy I want to make money. That's this. So it's a bit more expensive. A lot of my like all access Diamond Club members have added the Project Options Edge service to it just because, these are pretty loyal members that are trading with me year round anyway. And so they want all of my trades, from little services and mechanical trades to whatever Chris trades on the outskirts that he doesn't really talk about a lot. I'm doing a lot of these trades with Project Options Edge. Pinch point scanner. This just came out. This is a scanner that will feed you trades every day. This is over almost 10,000 stocks we're looking at. I'm looking at the get set filter and the go filter to try to find something actionable. We have 26 stocks that are primed and ready for a move. They're not all tradable in my opinion. I want to trade them. It's just sometimes I'm very picky on the option chain. If the market is expecting like a $2 move and the option strikes are $5 apart, I'm not going to take the trade. So the only way I'm picky on this go filter is if I have an option chain that doesn't look that good. And sometimes it happens, sometimes it doesn't. But we're in like 18 trades total since like last week or 2 weeks ago Wednesday. So over the course of basically a week and a half, we're in 18 trades. So it's going to be a very active service. We've already had 2 trades close out for winners. The broker automatically does that for me because it's set to take profit. So that is my pinch point scanner. Okay, VIP All Access is that's the top dog price. That's like you're buying everything. Okay, A1 Trading, I'm live with them through the day. Like 10:15 is my segment during the day, Monday through Friday. I also offer an alert service with them. And then I've got some oldies and goodies. Like these are full course. This is a $27 options course. This is a $497 option course. This one is you can rent or buy these videos for like $9.95. So, just some stuff to get out, like price patterns, support resistance, market patterns, structure, and then option trading. I think, this is really where I'm trading a lot now. Better portfolio management, better risk adjusted returns, a lot of versatility, a lot of agility and nimbleness in the market. So if you have any questions on this is why I have a Discord channel. I can put all my content in one place. And if you have any questions, you can reach me here every single day. So, this is me. Yeah, let me just post like a live chat test in live YouTube session now. Okay, so that's me posting this message. And if you want to find me, you can find me right here. If you come into my Discord channel and all of a sudden there's a fake Chris Pulver that reaches out to you, or a scammer that you think it's not me, I can promise you that. That's literally what rules are for. Okay, no direct messages. I don't send them. And friend requests. If you want to message me, best place to find me is here in the public channels. Okay. All right, so here's what I'll do. For this Discord, I will share. I'm going to do like a 30-minute link here. So let's do edit link. This is going to be good for 30 minutes and then it's going to expire. So if you want to join live, now's the chance to do it. So copy. This will be Chris Pulver Trading Discord. There we go. And I have a free Telegram channel as well. You're welcome to join that and follow along if you'd like. So almost 2,000 subscribers to this. Send this out. You're more than welcome to follow along. There. So Telegram to follow me. I'm active on this thing every single day. Discord active every single day. Obviously in the live markets every single day. So hopefully there's something for everybody. Inexpensive education, premium education, live trading services, live trading alerts, all that stuff. And if you have any questions, let me know. All right, let's do it again tomorrow. Thanks everybody. Thanks for being here. Appreciate it. And have a good day. See you tomorrow. Bye.